If you've been trading for a while and you still can't tell whether to buy or sell with any real confidence, this video is going to fix that exact problem. I'm going to be showing you exactly how I read market direction before I even open a chart, using the one thing that most traders completely ignore. And this is the exact piece that took my $150 account to over $1.4 million by using this one thing. And this was all documented live in front of thousands of people before any single trade was taken. I would send out exactly what I'm looking at. Now, before you click off thinking that this is another indicator or another strategy, it's quite the opposite. I'm going to show you exactly why the candlesticks that you stare at all day are lying to you and exactly what moves them behind the scenes. So in this video, I'm going to be revealing the 3 things that you need to understand to read market direction the same way that I do. And that's how to 1, filter out what's worth trading, 2, identify the market sentiment, and 3, properly time your entries. Let's get right into it. Now, the very first thing that we need to do when we're trading is actually identifying what we should be trading. So the first step is going to forexfactory.com. And if you guys don't know, Forex Factory is essentially a hub of all the fundamental data releases that are going to be going on in the markets. Now, you guys can see over here, we'll have some news, as you guys can see up here, news/latest stories. It'll show you all the currency majors and everything, how much they've changed over the last couple hours. But this is where it gets interesting. You'll start to see we have a ton of news releases, yellow folders, orange folders, red folders. It's all over the place. Now, all of this means absolutely nothing except for this part. You want to click this little button over here, click filter, change the impact to none, and then only select orange and red. This means that we're only looking at the actual economical news that's going to cause a significant move in the market. Now, you might be wondering which ones are actually important. So obviously we have all of these over here. Based on whatever strategy you use is going to determine which news releases you actually need to pay attention to. So me, myself, I only trade Dow Jones and NASDAQ nowadays, meaning that I only need to focus on one economical outlook, which is going to be the USR. So I come over here, I click none, and I click USD. Some people might be trading GBP USD. So in that case, they'll be looking at the GBP and the USD. Now, this starts to get tricky because you always have to be focused on 2 different economies, which is why I personally only like to focus on indices, because I know this strategy works best with it as you're only looking at one economy. It makes it so much simpler. And from there, I can click up here, set from the 1st to the 31st, and see my entire month schedule of trading all like this. And this is going to tell me exactly which days to trade, because if we don't have news on that day, I can just take that day off. So you guys can see this first week over here, we had Wednesday, July 1st, July 2nd, and then absolutely nothing until Monday, July 6th. July 2nd would have been a day off. July 8th and 9th, we would have traded. Now, you guys can see very dry from the 10th through the 13th, then the 14th, 15th, 16th, 17th, very heavy. But then we get a week like the current week that I'm in right now, and 18, 19, 20, 21, absolutely no trading days, even the 22nd. And the only trading day that I'm going to be getting this week is July 23rd. Now, even though it is a trading day for me, it doesn't mean that I have to take a setup. Understand, you first have to identify which day you're going to trade, which is what I just showed you guys. And then from there, we have to identify the sentiment. So let's get right into that. Now, the first thing that we want to do when it comes to identifying our market sentiment is looking at the news forecast, right? Now, this is going to be important because the news forecast is basically telling us what they're expecting to happen in the economy. And when we look at a deeper value of this, it's not just some random number. This is an economical release, just like this, right? This is exactly what you guys are going to see. You're going to be on forexfactory.com. You're going to see a news release that hasn't come out yet. You know it hasn't come out yet because the actual is blank. Now, this is going to be all the information that you have. So let's actually break this down. We have the previous, which is basically showing us how many people claimed unemployment last time. So 208,000, right? And this is going to be different across different news releases. Some of them are going to be based around inflation or stuff, and they'll be based in percentages. Some of them are points, as in 50.0, 49.5, etc., and so on and so forth. So right here, we had 208,000 unemployment claims, but the forecast is going to be 211,000. So if we do the math over here, if 211,000 people are now going to be claiming unemployment, that's going to be 3,000 new claims versus the previous, right? So at this point, we're expecting, and big emphasis on expecting, there to be 3,000 more people claiming unemployment. And the thing is, when we have this forecast, what the forecast is doing is all the candlesticks that are building up prior, the way that the markets are actually being priced in, are completely based off of this data. But I don't like trading beforehand. I like trading the actual. So hypothetically speaking, let's say that the actual comes out at 220K. At this point, we can see, okay, that's 9,000 more unemployment claims than the actual. And this is where we actually have to start to analyze it. So we would have a forecast of 211,000 and an actual of 220, right? And that simple math is going to lead to 9,000 more people claiming unemployment. Now, we have to start to look at it like this. What does this mean for the economy? We have to start to reverse engineer the mind of an investor and also the way that the actual Federal Reserve works. So right now, the way that the Federal Reserve works is by controlling all of the interest rates and everything. So in order for the interest rates to come down, we have to see the economy suffering. So if more people are claiming unemployment, let's just break it down. That means that less people are working jobs. Now, if less people are working jobs, that means that less people are making money. And if less people are making money, then the economy is suffering. Now, what happens with interest rates when the economy is suffering? Well, when the economy suffers, interest rates actually start to drop, right? So you guys will see that interest rates drop because the cost of borrowing money has to get cheaper if people can no longer sustain this lifestyle. Now, on the other hand, let's say that there's less unemployment claims, right? Let's say that we get this news release to be 200,000. That means that we missed the forecast by 11,000. And what that's going to tell us, and in this exact scenario, that would mean that we have 11,000 less than the forecast. That means, which equals more people are employed, which would mean that more people are making money, which means that interest rates are going to stay high. Now that we know how to identify whether the interest rates are going to be high or whether they're going to be cut, that's where we have to actually start to look at what's this going to mean for an investor. So there's one very simple rule. The cost to borrow money is cheap, and we see investors invest their money heavily. And you really have to think of it like this. Imagine you had to borrow $100,000, right? And after the year ends, you have to return it as $103,000, right? This is an example of a lower interest rate. If I'm an investor, I look at this opportunity and I say, okay, I can borrow this right here, only owe $3,000, but the potential of me making more money is way higher by borrowing this money. And maybe I turn this into $150,000, right? And at the end of that, I'm left with a $47,000 profit. Now, this is just hypothetical numbers just to try to make this easier for you guys. Now, but on the other hand, we have the opposite factor. So if the cost to borrow money is heavy or high, then investors invest less money, right? So think of it like this. Once again, if I'm borrowing $100,000, but I have to return it at $125,000, well, why would I want to borrow that money? It seems like a higher risk. And then at the end of the day, maybe I'm only going to make $120,000. And at that case, I've lost $5K. Or, there's also opportunity cost. Maybe I'm only going to make $130,000 on this. And it's like, was it worth it to borrow this money to only make $5K on it when I could have invested it elsewhere? So this is really a simplified version of how the investor is going to look at the market. They're always trying to find a way, how can I make the most return on my dollar? So if we actually see the economy suffering, that's going to be a good sign for the investor because that's telling us economically, the interest rates cannot stay this high. But if you have a thriving economy, that's going to tell us, hey, you know what? The economy can't stay this high. So we might even make the cost of borrowing money more expensive. We might see rates increase. And this is really where we're at. And so that's why I always wait for the actual, so that way I can see, okay, what is this signaling? And then how do we actually take that data and trade it? And I'm going to show you guys that in a sec. But before we get into that, guys, make sure that you are always trading on the best broker. So the broker that I use actually has a 250% deposit bonus, meaning if you put in $100, they're going to give you $250 in bonus to trade with. All you have to do is sign up on the link in the description and then put in promo code OLITRADES. It has to be all lowercase. They got fast deposits, fast withdrawals, and airtight spreads. So make sure you guys are on there. But let's get back to the video. So from this point on, all that we have to do is time our entries. So we already know step one is finding which day to trade. And that's by going to forexfactory.com. And then step two is identifying the market sentiment. Is it bullish or bearish? And then we have step three, which is timing our entries. Now I'm going to be showing you guys literally the holy grail. Like, I have never seen a better system than this for actually executing your entries. And it is so unbelievably simple. We all should know basic uptrends and downtrends, right? An uptrend is where you have a low, a high, higher low, higher high, higher low, higher high. And then a downtrend is where you have a high, a low, lower high, lower low, lower high, lower low. Now, price doesn't pull back to random areas. What they do is they pull back to demand levels. This would be considered a demand level on a bullish order, right? Same as this over here. These are going to be signified by the lowest candlestick before price breaks structure, right? So this is our structure over here. Every single lowest candlestick will be what we highlight, and then so on and so forth. And that's what we're looking for price to pull back into. Now, same exact thing for bearish orders, except instead of these being called demand levels, they're going to be levels of supply, right? So we have a lot of inventory. We need to sell it off. That's a very easy way to put it. But guys, to be fair, as long as you draw them right, it really doesn't matter what you call them. You could call them the green goblin zone if you want. As long as you draw them right, that's all that matters. And all these are going to be are the highest candlesticks before price break structure. Now, make sure you guys write this down or screenshot it or do whatever you need to. But always understand we have this one rule of thumb. If the economy is inflationary, that means that indices will go down. And at that point, we are only trading supply levels. And then we also have the opposite. If the economy is deflationary, that means that indices will go up. So that means we're only trading demand levels. Now, this is going to eliminate half of the guesswork for you, right? Because at the end of the day, you no longer have to guess, is price going to move bullishly or is it going to move bearishly? No, you already know. There's only one direction that you're looking for. And guess what? If you're on a day where the economy printed out deflationary, so you're betting the indices are going up, and for some reason your chart just isn't going up, all you do is simply step away. There is no reason that you need to be chasing the markets. There's absolutely no reason. If you want to stay unprofitable, that's what you do. But if you finally want to become a profitable trader, you need to know that you're not chasing the markets. You know the direction, you've identified it, and then you move with it. This pattern is exactly what we're going to be looking for only in demand levels. Now, not for supply levels. This one is specifically for demand levels. And what we want to see is a bearish candlestick, right? And notice this green zone over here is our demand level. This is our key zone. That's that lowest candlestick for price broke structure. So now we have already identified at this point that the economy would be bullish. So we're only looking at demand levels. We want to see a bearish candlestick, and then we want to see an indecisive candlestick. It doesn't matter whether it's bearish or bullish. Just the most important thing is that this candlestick prints as an indecisive candlestick. Now, an indecisive candlestick is going to be where the body is relatively small. You know, price really didn't show that clear of a direction and usually has a long wick like this. So it doesn't matter whether this wick's below the previous, whether it's within the previous. All we want is bearish and then indecisive. The most important thing is that they touch our demand zone, and then this is it. You want to take your Fibonacci tool, measure the 50%. If you guys don't have a Fibonacci tool on your screen, all you have to do is click over here, Fib retracement. If you don't have the settings, double click it right here. All I have is 1, 0, and 0.5. Now, the most important thing is that we see that last candlestick be bullish and close above the 50% level. Now, sometimes you'll have a couple bearish patterns in here. Sometimes you'll have this one close, halfway or something. This is exactly what I want to see. Finally, when that candlestick closes above that 50% level, and exactly what that's telling me is that price has now given me my confirmation to go long. So at this point, I would be entering a long on this trade, stops below my entire zone, take profit at the previous high or whatever it is, because think about it. If we are moving in an uptrend, right? If price really is moving like this and we're entering at this level here, all we know is that we have to create a higher high if we really are bullish. Everything else is going to be guesswork. So all this, I don't care about at all. I just look to target that previous high. And then very similarly, guys, this would be our supply level right here, right? And leading into this supply level, what we want to see is a bullish candle, just like this. Then we want to see an indecisive candle. Doesn't matter whether it prints bullish or bearish. And that's why I'm doing the half green, half red for you guys. And then we want to see a bearish candle print below the 50%. Now it could close way below it, but all that really matters for this is that we see it close below the 50%. So I draw these from wick to wick, not body to body, not body to wick. I draw wick to wick on that candlestick and I have to see it close below the 50. Then that would now be my short, stops above the entire zone, and then take profit at the previous low, because the same exact thing, right? If we have this over here, price is really moving bearish and we're getting in at this level over here, all we know is that we have to create a lower low. So we take it to that point. Anything else from that moment doesn't matter. It really doesn't. It could run 1,000 extra points. I really do not care, because in the long run, that will not make me profitable. And so now let me show you guys some actual examples using all three of these steps pieced together so you guys can finally cement this in your brain and start making some money using this strategy and start to actually use this strategy on the charts. So here you guys can see the news from last week. We had core CPI month over month, CPI year over year. Now, this is very important because you guys can see all of these news releases came out red. I'm looking at the actual 0.0 versus 0.2, 2.6 versus 2.8, negative 0.4% minus negative 0.1, 3.5% versus 3.8%. So what this is showing me is all the inflation is coming down. Now, if inflation is coming down, that is once again a sign that we can cut the interest rates, because the prices of everything are now dropping, right? So this is a great sign for economy. All of this is going to revolve around the inflation. So this, to me, seeing all of these news releases come out with negative reports for CPI was now telling me that I have to be bullish on indices. And so from this point on, we're going to go back to July 14th at 5:30 a.m. Pacific. And you guys can see this is actually the exact trade that I ended up taking. And it's very simple. The news gets released and we get this one absolute whale of a candle. Now, I'm not looking to chase that. Just because the market's already flying and I have the fundamental bias that I'm looking to go bullish doesn't mean that I just enter up here, because guess what? My stops would have to be all the way down, way over here. And at the end of the day, that's just not worth it. So what we do over here is we analyze and we identify, okay, this is now the lowest candlestick before price breaks structure towards the upside. So there's absolutely no reason why I have to be looking at anything on this candlestick before that moment. Right? Zero reason at all. So then I mark out this zone over here, and then I just wait for that same exact candlestick confirmation. And now I know that on this chart over here, it does look like it just slightly wicks under, but actually on the broker I use, as well as the other chart over here, you guys can see it actually does not. And this is why I always say it's very important to be using a very strong broker, because at the end of the day, sometimes TradingView gets it wrong, and you want your TradingView and your broker to be in alignment before you enter a position. So once again, guys, the broker that I use, I'm leaving the link to that in the description so you guys can join that. But once it enters this level, we get bearish, indecisive, and then we finally get the bullish above the 50 right here. I end up hopping into this trade. Now, there is one very simple rule of thumb, which is target the previous high. But also, guys, the same exact reason why we get into a trade has to be the same exact reason why we get out of it, right? And you guys can see price, I end up getting out over here. But if I just target that previous high, boom, a 1 to 4.3 risk to reward ratio, being absolutely smashed on that setup. And at the same time, guys, I sent all of these fundamental breakdowns in my free Telegram, just like this one. I said CPI completely misses, proof that the economy is suffering, good indication towards rate cuts. This is a very bullish indices remark, right? So everybody in my free Telegram already knew just 3 minutes after that news was released that price is going to move bullish. And I had so many students sending me their profits on this. And if you guys want to be a part of that, the link is also in the description. It is 100% free. But let's get into the next example. Here we're going to go to July 15th, and you guys can see core PPI and PPI month over month both came out less than expected. So once again, we're seeing the economy is suffering. This is going to be a bullish indices remark. So when I actually go to my charts over here, and now we can fast forward to July 15th. And so here you guys can see July 15th at 5:30 a.m. Now let's get rid of this original zone over here, but let's mark out this demand level down here. I've already identified I'm only looking for a bullish order. But you guys can see when price comes in here, we get bearish, indecisive, and then we wick right through that zone. So there's absolutely no reason why I should be entering this trade right over here. It makes absolutely no sense for me, right? But let's check out US 30. You guys can see over here, news gets released, price moves up, comes down, and then breaks structure towards the upside. So once we broke this structure towards the upside, I then go ahead and I mark out my zone right here. This is right at New York Stock Exchange open. Then price rallies on upwards, comes back, gives me bearish, indecisive, bullish above the 50. I hop into this trade, and you guys can see price pulls up, you target the previous high, you hit take profit right there. But same reason why you get into a trade should be the same reason why you get out. So as you guys can see over here, we had bullish, indecisive, and then a bearish below the 50, leading me to get out of that trade right there, securing my profits. Because at the end of the day, all we want to do is maximize our chances of winning, right? Nothing in this industry is given. It's not like the longer you're in a trade, the more you're guaranteed to make. It's nothing like that. It's so different from traditional jobs that we actually have to continuously maximize what we're doing. And guys, like always, this one was also shared in my free Telegram. As you guys can see right here, PPI and core PPI both came out below expectation, proof that the economy is suffering, and a good indication towards rate cuts, taking this as a very bullish indices remark. And so for the final example on that week of news, we have unemployment claims, right? And the unemployment claims that week came out less than expected. And so I showed it like this. Unemployment claims are down, more people are employed, more money in the economy, more spending equals inflationary, taking this as a bearish indices remark. So at this point, I'm only looking to use that supply level, right? So that news release came out at 5:30 a.m. on July 16th. So now if we go back to July 16th, 5:30 a.m. on NASDAQ, you guys can see I wait, and price actually rallies on upwards over here, and then gives us this big break of structure towards the downside. So even though price was rallying up, all I did was stay patient. I don't need to try to hop in and maximize the buys on the way up or keep trying to short it. No, I waited for price to finally break structure towards the downside. So even if you look at all this, there's literally not one single shift in structure towards the downside until this level here. And what we do from there is we mark out our supply level. So I marked that out. Then you guys can see we have bullish, indecisive, bearish below the 50. That was the first opportunity to get in. Now, as you guys saw, my message wasn't sent until 7:03 a.m. I did see this a little bit late. So I didn't get in until this level right here, 7:47 a.m. But it just shows you guys how many times do we get that opportunity. Bullish, indecisive. We had another bullish, indecisive, bearish below the 50 right there. But eventually I get in right around here, stops above that high, take profits at the low. Same reason why I get in is the same reason why I get out. So at this point over here, when we had the bearish, indecisive, bullish above the 50, I closed out on my position right there. But had you held that position, you still would have profited. So it's really a trade-off. I like closing out because that actually increases my win rate, and I like that consistency in it. You know, I like to continuously win. You could make the argument that had I held out all those trades, maybe it would add up to more profit. I don't know. At the end of the day, I just know that my system is exactly what's printing for me. So that's the entire thing. That's exactly how you filter out what's worth trading, how you identify the market sentiment, and how to properly time your entries. And if you actually do that, I have no doubt that you'll stop guessing whether you need to buy or sell and start reading the data and the charts the way that they should be read. It's the exact shift that changed everything for me. Now, could you figure this out on your own? Maybe, but it's going to take you a ton of blown accounts, a ton of time spent figuring out which news releases are actually going to be worth your time, which news sources are credible, and exactly how to break them down. And that's exactly why I created my free Telegram, where I share all those fundamental outlooks like you guys saw right there, so you can actually see exactly what I'm seeing in the market before it even happened. And if you guys want to join that, make sure to click the link in the description. And if you guys enjoyed this video, make sure to like and subscribe to the channel, and let me know in the comments, what did you guys learn from this video? What are you going to implement from this to actually make you a better trader? And I'll see you all in the next one.